Summary book: The Smartest Guys in the Room, The Amazing Rise and Scandalous Fall of Enron by Bethany, McLean and Peter Elkind. The Smartest Guys in the Room is a deeply investigative and compelling narrative about one of the largest and most infamous corporate scandals in American history. Co-authored by Bethany McLean, a journalist who was among the first to probe the inner workings of Enron, and Peter Elkind, a writer and editor, the book provides a comprehensive and riveting account of the rise and fall of Enron Corporation, once one of the most admired companies in the world, now synonymous with corporate fraud, greed, and corruption. The rise of Enron. Enron, founded in 1985 by Kenneth, began as a small natural gas pipeline company, but it quickly transformed into a corporate giant. Under the leadership of and later the visionary yet controversial CEO Jeffrey Skilling, Enron became a symbol of innovation and success in the energy sector. The company adopted an ambitious new business model focused on energy trading, betting on the deregulation of energy markets to fuel its meteoric growth. Enron pioneered the creation of an energy trading market, offering financial products that allowed companies to hedge against future energy price fluctuations, and it quickly grew into one of the world's largest companies. Skilling's innovative vision led to the development of Enron's infamous trading floor, where traders and analysts engaged in complex financial deals that appeared to be lucrative. The company boasted of its transformation into a new kind of corporation, a leader in both energy and financial markets. Enron also used its innovative accounting practices to record significant profits, even when its underlying financial reality was shaky at best. The company became a darling of Wall Street, and its stock price soared as analysts and investors praised Enron's seeming ingenuity. As Enron expanded, it attracted a talented group of executives and professionals, many of whom were highly intelligent and highly ambitious. The company prided itself on employing the smartest guys in the room and encouraged a hyper-competitive corporate culture where success was rewarded handsomely, but failure was not tolerated. This culture of arrogance, coupled with a lack of transparency, would eventually prove to be its undoing. The deception begins. While Enron was seen as a revolutionary company, behind the scenes, a dark truth was unfolding. The company's rapid expansion was built on risky, unsustainable practices. Enron relied heavily on mark-to-market accounting, which allowed it to recognize profits before actually realizing them, basically claiming revenue for deals that hadn't yet been executed or for projects that might not ever come to fruition. This accounting method, while legal, was highly misleading and contributed to the illusion of a highly profitable and growing company. In addition to the flawed accounting methods, Enron engaged in special-purpose entities, SPEs, off-the-books partnerships that allowed it to hide massive amounts of debt and inflate the value of its assets. These SPEs were designed to keep Enron's debt from showing up on its balance sheet, giving the appearance of a strong financial position, while in reality, the company was drowning in debt. Enron executives, led by Skilling and CFO Andrew Fastow, used these tactics to deceive investors, analysts, and regulators, presenting an image of financial health while masking the company's true instability. Fastow, in particular, played a pivotal role in orchestrating the schemes that concealed the company's liabilities. He created a network of shadow companies in complex financial transactions that allowed Enron to hide billions of dollars in debt and liabilities. The company's top executives, including Skilling, and Fastow, were fully aware of the risks they were taking and the deception they were perpetuating, but they continued to lie to the public and the market in order to protect their lucrative bonuses, stock options, and personal wealth. The fall. The collapse of Enron began to take shape when Bethany McLean, a reporter for Fortune, questioned Enron's financial practices in a 2001 article. McLean's investigation into the company's financial statements, which seemed suspiciously opaque, sparked a chain reaction that would ultimately unravel the entire empire. The company's accounting practices came under greater scrutiny, and soon, analysts, journalists, and regulators began to dig deeper into Enron's financial dealings. As the truth emerged, Enron's stock price plummeted from its high of over $90 per share to less than $1. By the end of 2001, the company filed for bankruptcy protection under Chapter 11 of the U.S. Bankruptcy Code, marking the largest bankruptcy filing in U.S. history at the time. In addition to the loss of billions of dollars in shareholder value, thousands of employees lost their jobs, savings, and pensions. The bankruptcy also devastated the pension plans of employees, many of whom had invested their retirement funds in Enron stock. The scandal exposed the depths of corporate malfeasance, and the once gilded image of Enron's leadership began to tarnish irreparably. Both Lay and Skilling were indicted for fraud, conspiracy, and insider trading. Fasto, the architect of the deceptive financial structures, was arrested and cooperated with authorities in exchange for a reduced sentence. In 2006, Jeffrey Skilling was convicted on multiple charges, including securities fraud, and sentenced to 24 years in prison, later reduced to 14 years. Kenneth Lay, who had initially been convicted on similar charges, died of a heart attack before he could be sentenced. Andrew Fasto received a 6-year sentence after agreeing to cooperate with prosecutors. The legacy of Enron. The Smartest Guys in the Room reveals how a combination of corporate culture, personal ambition, and a disregard for ethical behavior led to the creation of a web of deceit that ultimately destroyed Enron and left its employees, investors, and the public reeling. The book highlights the dangerous interplay between Wall Street, corporate leadership, and financial deregulation, illustrating how Enron's executives were able to manipulate their financial statements to create the illusion of a wildly successful company. The authors also discuss the broader implications of the Enron scandal for corporate America. The company's fall forced a re-evaluation of corporate governance, financial oversight, and accounting practices in the United States. Enron's collapse led to the Sarbanes-Oxley Act of 2002, which instituted more stringent regulations on financial reporting and corporate transparency. The Enron debacle also underscored the need for independent auditing and more effective oversight of corporate activities. The story of Enron is a cautionary tale about unchecked corporate greed, the dangers of excessive ambition, and the consequences of placing profits above ethical responsibility. Through detailed interviews, insider accounts, and thorough research, McLean and Elkind paint a vivid portrait of how a corporate empire built on deception can crumble, leaving devastation in its wake. The Smartest Guys in the Room is not just a book about the fall of a company, it's a critical examination of the culture of corporate corruption, the dangers of financial innovation without oversight, and the lengths to which individuals will go to protect their wealth and power. The story of Enron is as much a story about human nature as it is about business, ambition, and betrayal.